What's up guys, Silver Dave here, and gold has crashed, and it's crashed a lot. It went down, I think yesterday it was almost like 3-4%. Anyways, it's down for over $100 from its high point. So let's find out what might be causing gold to crash. So gold did take a nosedive, and like it happened right after the events recently, and yeah, it's a big dip. But you know what are some of the reasons why? Because I've been watching quite a few videos, and it seems like nobody knows why it dipped. And for me, when I look at this, and when I look at the volumes that were sold on that day, like over the course of these last 2 days, I almost suspect that there's two things that's happening. Number one, the dollar strengthened, interest rates went up in the U.S., but that by itself doesn't explain all of it. Because even though interest rates have been going up, the dollar has been weakening, which normally is a little bit controversial because when interest rates tend to go up, the dollar tends to strengthen. However, if interest rates are going up and the dollar is weakening, it means that even though interest rates are up, the dollar is still considered a weak asset, and that bonds are expensive and people don't want to hold bonds. So there. But that's one possible, that's sort of the mainstream possible explanation. Another explanation I think that nobody is talking about is I do suspect, and you cannot really prove it, you can kind of get some sort of information on it, but it's not totally transparent, is that some central banks are selling gold. And they're not doing this to manipulate the price of gold to drop it. But I do believe that, many of the Central Asian countries, which have large holdings of gold, because of liquidity issues and because of balance sheet issues, they need to sell their gold positions. And let me explain. Most countries have, I would say, foreign reserves, right? If you're not the United States, everybody needs to hold foreign reserves. The reason everybody needs to hold foreign reserve is because they need to trade. And the US dollar is the reserve currency. You cannot do international trade with the Uzbeki som. You just can't do that. Not many countries will accept the Uzbeki som in exchange for their goods and services. So the other part that a lot of people don't realize is that if you're buying something from China, from a supplier in China, most of the times you're not paying in Chinese yuan. You're paying them in dollars. And if you are like a Central Asian country, and right now you need goods and services, and most countries are not manufacturing, and the only manufacturer that's open is China, and you don't have a lot of yuan, your other choice is to pay them in dollars. Now, I'm saying that a lot of these countries are selling gold is because they have large gold reserves. Right now, they're coming out of a pandemic. They do need to have a circulating economy. They do need to import goods. And the central banks most likely are selling gold in order to provide foreign currency liquidity. And I made a little sketch to explain how it works. In a normal, so I did this sort of cartoon thing to show everybody it's a simplified version of international trade, essentially. So if you are Uzbekistan and you want to do international trade, and also to back this up a little bit, I do have news that in 2009, Uzbekistan had one of the, I didn't pick it by random why I picked Uzbekistan. Uzbekistan had a large outstanding unrealized amount of gold, and its balance sheet was bloated with gold. And some of the recommendations for Uzbekistan by the IMF was that it should sell some of its gold reserve to shore up foreign currency reserves. And you're like, wow, the IMF's so evil. No, the IMF is telling this because central banks really don't care so much about making a profit or loss. They care a lot about liquidity. That's why it's so confusing when you look at some of the actions of a central bank. You know, a central bank tends to do a lot of things that's contrary to good business practices for an individual. But you have to think that a central bank isn't a person, isn't an individual. It's like a government employee that has a job to make sure that people are buying and trading goods in the economy. That's its only job, to provide liquidity, lubricant for the economy. And I think that the central bank chairman said that, they will sell gold and they will sell more gold if they think that, the price is good for them to sell gold and they need to shore up their dollar reserves. I'll post a link to these articles. It's more or less, if you read between the lines, because central bankers never tell you exactly what they're doing. They have a very good reason to, because if they do, their moves are huge. When a central bank sells gold, it's a huge move. Any central bank, they're not selling like a few, 1,000 ounces. They're selling tons of gold. So if you know in advance that they're going to sell gold and you short gold before their sale, you're going to make a lot of money. So they typically do not want you to know ahead of time, so that there's no I would say market sort of insider information trading type of scheme. I think one Swiss central banker got caught because his wife got privileged information about the Swiss currency policies, and she made trades based upon that, and he had to resign. So they're not allowed to talk in detail about their trade action. So you will never find news about these type of large central bank sales. The good thing is they typically are one-off events. But let's go back to our funny cartoon about why for example, if you're the Uzbeki central bank, and a central bank with a lot of gold reserves right now, why you might need to sell some of your gold. So if you are, let's say, a normal Uzbeki business, and you live in the country, you earn your money in soms, you do your accounting in soms, and your profit and balances are in soms, and you live your daily life as a manager or the owner of this business, by using soms to buy your milk and so on. So you need soms. And in order to get more soms, you run your business selling computers, right? And people in the population, your customers, they have soms. Now, to get a computer, you will have to buy this computer from, well, guess who? China, because they make computers. And you buy your computer from China, and to pay your Chinese manufacturer, you don't have any Chinese yuan in this case, because it's not a world reserve currency. Not every country has Chinese yuan or Chinese RMB. You decide to pay them with dollars, which they do accept because it's a world reserve currency. So in order to do that, you as the Uzbeki business person, you take your som, you go to your central bank, and you trade your som for dollars you don't go to a central bank, you go to your bank, and then the bank has access to foreign reserves, and then he trades soms against dollars, and then he gives you dollars, right? Now you have dollars, and you give it to your Chinese counterpart. He takes his dollars, he goes to his banks, he trades dollars for Chinese yuan because he needs Chinese yuan or Chinese RMB to pay his workers who make the computer. And this computer finally goes to the Uzbeki business person or the Uzbeki business, and he sells this computer to his customers who give him som, and he's really happy. Now he decides to do this. Okay, I got one som, now I want a second som. A computer doesn't cost one som, but this is to simplify the explanation. And he decides to do this again. Well, you know what? Last time, he already paid his dollar. So this time he still needs to pay the dollar, right? But there is no more dollar in Uzbekistan. So he takes his som, he goes to the bank, And he's like, yeah, I want to have some dollars. And I'm like, oh crap, we don't have foreign reserves anymore. What do we do? Well, we need to sell gold. Yep, they need dollars in this case to make sure that they can get computers and people can work, people can watch YouTube, people can make YouTube videos, people can write novels, whatever. So in this case, their choice, their best action in this case, they could either try to sell SOMs and on the international market and get dollars, but that's pretty futile because it's not a widely useful currency. At least with the Chinese RMB, you can sell it on the international market because people know that they can come back to the Chinese business person and pay him also in Chinese RMB or Chinese yuan. I'm saying the two names because it has two names, which tends to be quite confusing. But the CNY is the official currency of China. So what do? Well, they decide that, okay, well, we can sell gold. So we will sell 2 of our gold. These stars are gold. And we will sell it to on Wall Street, through the open market. And why I put Wall Street is because pretty much the world's financial system is Wall Street. Every single I would say like most transactions around the world, financial transaction, happen through either a Wall Street entity or entity related to a Wall Street entity, right? These local banks, they mainly do local commercial actions. There's very few banks that have such a wide-reaching network as the U.S. banks. So here we go, 2 gold, go to Wall Street, they go in here, let's move this, boom, here, and Wall Street gets the gold. They're like, okay, some investors, some bullion bank is like, okay, let's buy the gold, right? And then we can use the gold and we can use it and take it to the U.S. Federal Reserve, and then we can get dollars out here, and we can use this as a guarantee, as collateral against the Federal Reserve, and we can give you $2. And boom, now they have dollars. And you're like, yay! So now he can go and we can run the business again. We can have this business and we can have more of this, and then it goes around, and then we have, liquidity again, right? Then the next part, there's other parts too, and this also explains why people want debt and why the U.S. debt, despite the fact that the U.S. government is so indebted, people still buy debt, is because if you look at the other side of the picture, that at the manufacturer, he's got a ton of dollars, right? He's sitting on a lot of dollars, and he's making stuff. So essentially, he could also circulate internally by manufacturing and circulating his own PCs to his own people and get Chinese yuan and pay them in Chinese yuan, and it'll be fine. But here he's also got a ton of dollars, and he's like, hey, what can I do to make sure that the dollar doesn't devalue too much? I could probably reduce on the international exchange the amount of dollars against the Chinese RMB. So what he could do is he could take this, right, and he could go to the open market and start buying U.S. Treasury bonds. So he does go to these guys. He's like, look, I'm gonna give you $1, right, and you can give me a government bond. So he gets one more government bond, and then the Wall Street people are like, yay, we have more dollars, and we can use these dollars to get more government bonds here, and then we can get this government bond here. Here you go, some more government bonds. And then, you know what? The government's happy. They've made their transaction, and then they have this bond here. And then they can take this bond, they can get more dollars, and everybody's happy, and things are circulating. So that kind of explains why there's a sale of probably gold from a lot of Central Asian countries at the moment, because they're strapped for liquidity and they have large gold reserves. Does this mean that gold will keep dropping? I mean, I think there's a lot of reasons why gold is up right now. But overall, I see in the midterm because the dollar is actually continuously weakening against a whole slew of currencies out there. And it could be key, like if you look at this whole thing, right? Where is this? This whole thing. For example, if China stops buying US bonds and it stops providing extra liquidity into the open market, right? That could that could just devalue the dollar right there, relative to, for example, the Chinese yuan or RMB, which is happening. They are trying to make this the reserve currency, so that in this transaction, they don't use Wall Street as an intermediary because there's fees associated with transacting the dollar. Wall Street has to take their cut. They take like, I don't know, 2%, 3% of this whole exchange transaction fee. Maybe they want to keep that margin. Well, what if they just replace everything with the Chinese CNY, and then you can directly pay and be paid, with the CNY. They can sell gold straight to China, and that's one possibility. If you look at the Chinese central bank's balance sheet, they don't have a lot of gold. They have a lot of U.S. securities, and the main reason is they are supporting the dollar for a long time. They've been doing it for the past like 20 years because they essentially, up until now, is crucial, or even now, it's crucial for them to have a well-functioning dollar. And yeah, but the problem is right now is the Federal Reserve they're printing like crazy. They're like, yeah, you don't just need to give us collateral. We're going to just, go like this. Yeah, okay. Well, now we're going to do like this. Like print all the dollars you want. And then, Wall Street, you bought some bonds, exchange for dollars. Well, I'm going to give you a dollar and I'm going to buy more bonds. Hey, you have more bonds? Yeah, here you go. More dollars. Yeah, just dollar everywhere. Everybody, you want some dollars? Okay. Here you go, more dollars. Okay, we're gonna buy everything up. And then, oh, you want some gold? Here's some gold. There's somebody who want gold. Okay, we'll sell you that. Give it as collateral. We're gonna buy everything. Which is, if you look at this, you're like, hey, isn't that killing the dollar? I'm like, yeah, but it's a smart move. Look at it. I mean, what's happening on the other side? The Federal Reserve is getting a lot of assets. It's not bad. It's not a bad deal. Plus as a world reserve currency, everybody here is using the dollar, and they've got everybody's asset too. They're like, oh, you don't have any more dollars? Well, why don't you go and give us, I don't know, some natural gas? Let's see, barrel. Let's see if there's a barrel. Barrel. Let's see, gas. Here. Yeah, you've got gas. We'll take gas here. Here, give us some gas here. Some oil. We like oil too. Anyways, this isn't so bad for the United States because it's people are like, yeah, printing money is bad, but eventually, sooner or later, it provides a lot of upward pressure for commodities. Because essentially, the Federal Reserve has quasi unlimited purchasing power, and the dollar is really backed by two things. One, it is backed by the political stability of the United States. That's why when you saw the confirmation of all the Democrats, if you're a Republican, you're like, oh, I hate Democrats. But if you look at it from money doesn't care your political affiliation. It just cares that there's stability. It doesn't care who's in power. It cares that as long as the people in power are doing stable things, they're not like firing up a Twitter storm every single other day. So everybody else, all these people, like the Uzbeki guy, the Chinese manufacturer, the people buying the computer, the people working in making the computer, they all care about the dollar. It's not just people here, in Wall Street and U.S. citizens who care about the dollar. Everybody cares about the dollar. Like, what happens to the dollar affects everybody around the world. So to a certain extent, that now that this part of the thing, which is the debt part, that debt issuer, the government, is consolidated and stable, business and international business, every other business in the world and businesses in the United States are happier, right? They don't really care, oh, if there's potential future higher tax, as long as it can be expected and priced in, it's fine. It doesn't create anything too crazy. Your returns might not be a little bit weaker, but they'll be stable. It's not great if I would say that, things change from, there's a tariff today, there's another trade war, it changes every single day. Like, one of the things that happened during the Trump presidency is that policy changed from a day to the next. And you have things like, for example, now we're not talking about it now anymore, is TikTok. Is it banned or is it not banned? Is it really going to be banned? Is it not going to be banned? Or the 35 countries that are supposed to be delisted, and then there was like a 360 U-turn to say like, oh no, they're not going to be delisted. In the end, they're like, oh, maybe we're just going to delist the three telecom companies. It's like, it's a really, really, really like difficult place to invest because there's no fundamentals, and it's pretty much on the whim of a person to decide whether business is going to happen or not. And that's not how most businesses actually like to conduct business. They like to have long-term contracts, some sort of stability so that they can sell and buy things. If people expect things to be completely uncertain all the time, they will never buy a computer. It's not conductive to business. Look at countries that are going through turmoil and war. Just look at a lot of countries in the African continents, right? They have no stability, so they are poor. The ones that do are more stable. They are wealthier. It has nothing to do with natural. It does a little bit, but more so has to do with a country's stability. Just look at Switzerland. There's nothing in Switzerland. Like, really, there's no natural resources in Switzerland. The only asset here is that there's stability. So that's why there's a value in the currency. So lesson number one, during at least the last few days, there's a consolidation of power, and there's a consolidation of established power, and there's a consolidation of institutions and the credibility of institutions. And they've come out very, very strong, and they have a lot of political ammunition to crack down on dissent, which means that the dollar gets stronger. So that's going to already bring a little bit down the price of gold. The second thing is, countries that are around the world, central banks, they need to provide liquidity to their local economies. So they are going to sell gold, and that will provide short-term shocks on gold to bring the price down. However, because there's so much money floating around, right? You can see that basically I just copy pasted a ton of money bags. This is what the Federal Reserve is doing. It's printing out a ton of money bags. I would say the midterm to long term is that it's going to provide a lot of pressure on asset prices because literally the Federal Reserve can just buy everything up to provide liquidity. It would want collateral against its liquidity because eventually it will want to reduce liquidity. It doesn't want absolutely uncontrolled liquidity because that hurts its credibility too. So it would want some sort of collateral, which means that eventually all assets will trickle into the Federal Reserve, right? Or trickle into collateral against the US dollar at the Federal Reserve. Which means that, it will be a great day for the banks. It will be a great day for commodity producers because there's a lot of liquidity for them to sell their commodities. The price of commodities will face mild upward pressure. Despite the fact that people are selling things, they will face mild upward pressure. And I would say that at this point, the commodities will be, how would you say it? They would be typically, I wouldn't say that right now it's the top of the price of gold. Maybe it could go lower, what do I know? It's not financial advice. The way I see it is that there's long-term upward pressure for the price of gold, and the pressure is continuous as long as the Federal Reserve keeps printing money. I did the math. I think over the course of 4 years, it's going to put out another $7 trillion into the markets. So that's a lot of money. And that's money to fund the US government, but there's also liquidity man across the globe by other countries in order to buy goods and services. So, it might even have to do more than that $7 trillion in order to meet those demands and remain as a global reserve currency. And I think you don't really, is it a buying opportunity today? Is it a bad? I think that, there is the appearance of what could be a slight bullish channel, although it's not confirmed. We did have, for example, this appear before, and it was a bit tricky, but is this a bullish channel? It's hard to say. I mean, this is more like a flag. It's more like a triangle. Let's see. Yeah, that's more like a triangle. It's possible. If this channel is actually a channel, right? It's a very aggressive channel. And it would mean that this channel would move up super aggressively. And we're looking not just at like that, it would be like boom, 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 boom. And you would easily break over 2,000 gold next year. But who knows? Who knows? Maybe like tomorrow it will fall out the bottom and go back to like, 1,700 levels. That's also a possibility. However, I think that it's very unlikely, right? So don't trade upon this, because I do look at over the weekends when the gold markets are closed, I do look at the Swiss franc dollar market, and over the weekend I see that it's it has been weakening. It got some strength, some support yesterday, but since I would say since a few days ago, it's been further weakening. And if I look at the MACD, the 1-day MACD, I have the MACD of this, and I look at the 50 to 100, 50 to 90. It's still downward trending. It could potentially, it could go up a little bit. It depends. If here we see a further move downwards like that, it means that the dollar is going to keep going downwards. Even if it does, it's very unlikely that the dollar, if it keeps going down to this level, that it's going to go up. It's hard to say. I would say that we had the MACD move up a little bit, we had it go down. Possibly we could see it move up more, but it would depend on actions of the Federal Reserve. Now, if the dollar does start getting stronger, we could see a potential stronger bull market in the stocks, and people are like, that's crazy, the economy is completely dead. Yeah, but also you have to watch this. You have to be a bit careful. The interest rate, the U.S. Treasury interest rate has been rising. So, Treasury 10 CBO. Let's see. I don't have access to that. Treasury 10-year. iShares, NASDAQ, that's stock, 10-year. MHU bond yields, FX, 10-year. There is shares, bond futures, U.S. Treasury, continued March. Yeah, I'll go to 10-year treasury rate, and it's up. So we are at above 1%, 5 days. Yep, 1%. So yeah, it's been dropping, and now it's slowly moving up, the long-term yield. So that could spell problems for the stock market if it does become too high. I don't know if you remember, but when it when it got pretty strong in 2018 and 2019, there was you had a flash crash, I believe, in 2018, and you had another crash in 2019, and then we've been on a permanent slide downwards. They lowered after the crash, the repo crisis. They lowered the Fed injected further liquidity into the markets, and then we had the coronavirus. So right now, they said they won't go into negative. Potentially, what we're looking at is a call on the Fed's bluff, because the Fed ultimately doesn't want to print so much money just to shore up banks. But if the environment indicates that we will breach 1% interest rate and long-term interest rate is going to stay above 1%, it's possible that the Federal Reserve might step in and provide further liquidity. Now, what you have to realize is this means that to borrow is more expensive. It's becoming more expensive to borrow. And either that means that people are not able to borrow more, which could be a problem in this situation, especially if businesses are closed, that less businesses are able to borrow more, or there is there is not enough liquidity in the market. There's like a stress on liquidity, at least long-term fixed interest rate liquidity, and that could be another problem. So the Federal Reserve didn't want to do long-term maturities, said that we won't do, but we would if we have to, and we showed on the short-term maturities that we are able to. But if they do actually have to go into long-term maturities, then it means that is just going to be crazy. That will be crazy amounts of money printing. Something that we would have never seen before. It's possible. It was an all Democratic and Janet Yellen as the Treasury Secretary. And if they do that, I expect everything to go up. Like that, if they do decide, Janet Yellen's like, okay, the Federal Reserve, you can do like another like a long-term maturity intervention, and you can do every single month 100 billion and $1 trillion over the course of a year. We are going to see everything go up, and the dollar and bonds take a nosedive, right? Just a complete nosedive. And that would be I think right before that, we might see a stock market correction, right? A lot of people are looking at this and are like, oh, wow, we're going to see a stock market correction and stocks are going to sell off. That's possible. I think a lot of the growth stocks that are debt funded, they might sell off. Some of them might sell off because people might get worried. And if they do, then the Fed actually might step in and decide, okay, we need further liquidity in the banks and in businesses, and there's no lending programs, and the bankruptcy rate is getting too high, and then they just inject money. And then there's, on top of that, they inject money into the fiscal side, and they inject money onto the banking side, into the asset side. They might have to do it everywhere, and that would be a very aggressive move from the Federal Reserve if they do decide to do that. They do have a little bit of maneuver. They, if I look at the money velocity, M2, and the money velocity of M2, at least over the last few days, you can see, and they would have ammunition to do this, they could argue that, look, we decided to print a lot, but it's coming back. So if we print like a lot and then we manage to prop up the economy and there's support over the course of the next 5 years, we will recover our overall economic circulation. And that could be one of their choices that they decide to do, that they will decide to do even more money printing, because there is justification that, money printing will rebound relatively quickly. At least according to this chart, you never know whether it will rebound or not. That will depend on fiscal stimulus. Anyways, that's the explanation. Central Asian, a lot of countries who have gold holdings prior to the pandemic, a lot of them, probably the central banks, are selling that gold to provide extra liquidity for their businesses or their economies, so that they can trade with manufacturers who accept the dollar as payment to export goods. And these manufacturers are typically China, Vietnam, South Korea. These countries who are right now manufacturing goods and selling them abroad, they do take dollars, and because it's a world reserve currency, and they do use dollars to buy, I would say, bonds and other securities around the world. And this is one of the reasons why maybe that gold is gold's value is going down. Now, one of the things that could happen, and this would be the best scenario, is instead of securities, that they decide to use dollars and give it back to sell it on the open market. They sell their dollars on the open market and they exchange it for gold, and they start holding gold. And this could be something, because they're not net buyers of gold. For example, China doesn't have a lot of holdings in gold. It holds mainly US debt. But if they do decide that the exporters, that they don't want to hold US debt anymore, right? And they want to hold gold instead, that would be a very good scenario for gold, but very bad for the US economy and very bad for the overall circulation. And it would be great for commodities, but it would shoot the price of commodities through the roof if they start using commodities, start backing like trying to sell dollars and get commodities as they're onto their balance sheet. That would be not a that would shoot all commodities through the roof. Hopefully they don't do that, because then you would have real world inflation. You would have quite a lot of inflation, because then the business who's making the computers also has to go and buy oil, gold, silver, and all sorts of plastics, and that will be expensive. So they might not choose to buy commodities, but still accept to buy debt. So that's another part of it. Anyways, so remember, possible reason of the crash: stronger dollar, rising interest rates, but more so, I think there's, for it to move at such a large volume, if you look at the volume, it's a humongous volume. Let's see, loads. Let's see, 1 hour. I want to see the volume. Come on, give me volume. Give me volume. Okay, here we go. Here we go. I don't want this stuff anymore, this crap. Yep. Okay, so if we look at volume, this is very, very... So the last time we had a massive drop, it was during this period here. This was the largest movement of gold since I think it was like 20 years or something. It was like one of the largest movements of gold. And here we have matched and broken it. If we take the combined amount over the course of the last few days, we have matched and overtaken it in terms of volume that change hands. So yeah, it's a huge, huge sale of gold. So the only people that can really do this is not a bunch of individual investors. This is like a central bank or something similar that's doing it. Well, so that's my theory. Doesn't have to be. I don't think it's true. I could very well be wrong. I could very well be extremely wrong. And yeah, typically, you know, probably it will bottom out somewhere here, you know, in a few days, and then it will go back up again. So it could be a buying opportunity if you want to get into gold. It might be you might consider it as a buying opportunity. Do I think you back up the truck? No, never back up the truck. I did buy gold. I bought gold when it dipped down to here. I was like, it's like good price. I bought a little bit more. I bought a little bit more gold when it dipped down to here. I bought more. This time I bought paper gold because I filled up my brokerage account and I started like, I have my investment strategy for the next year. So I was like, I could buy a little bit of paper gold. So I'm buying a little bit of paper gold too. It's a Swiss like bank gold, paper gold. So it's pretty secure and vaulted. And I was like, okay, so I did buy like a little bit high, a little bit low, but you know, you can never be like on the winning side like all the time. That's not happening. And I was looking at valuations. I was like, yeah, there's a lot of things that like growth stocks, you know, they're going to go through like quite a volatile period. So I'm not investing into growth stocks, but I am in the stock market in certain indexes mainly for value plays, dividends, some emerging market stuff, and emerging market country bonds, which are relatively safe and usually stable countries. I would say not more than 10 years in that country, you'll be fine. And yeah, this is not investment advice. I'm just some dude on YouTube who's showing you stuff. So don't invest based on my advice. Do your own research, talk to your financial advisors, and ask them what you should do and what you should buy. Anyways, thank you very much for watching. Subscribe. I post content frequently. I'm not able to do everything daily. I'm working on a new version of I'm constantly trying to improve the machine learning process in order for predicting the price of gold, and it's taking me quite a while to actually get that marginal return, like to get it really working well. It's working quite well, but could be a little bit better, constantly tweaking it. Anyways, thank you very much for watching. Click the like button, the subscribe button. This is Dave out.